Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 26th of September. I'm Daniel Lam, your host for the podcast. One of my ex-colleagues, who was a very senior investment advisor, likened his job to that of a chef's, in that at different points in time, the chef will be serving different dishes. And in the case of an investment advisor, depending upon the investment environment and the macro situation, he or she will be advising the appropriate investment vehicle to the clients. Now, as the Fed started the rate cutting cycle, investors will be looking for income solution once again. The US Treasuries will be a purer play in terms of exposure to rate cut. But no doubt, many investors will be looking at corporate debt as well. So how is that looking on that front? Well, in the US, both investment grade and high yield corporate bond spreads are down significantly from their August highs. The average IG spread currently sits at 90 basis points, just 10 basis points above its cycle low. The average index high yield spread sits at 302 basis points, just 40 basis points above its cycle low. So looking back further than the past few years, we see that the average index IG spread is at its 16th percentile since 1995. While this is very low, it is justified by equally low levels of non-financial corporate sector gross leverage. What about for the high yields? Well, bond spreads remain tight despite an elevated speculative grade default rate. Now, the default rate is elevated because credit trends are worse at the very low end of the credit spectrum, especially for companies with floating rate obligations. But with the easing of the Fed cycle, the default rate seems to have peaked and likely to be trending down during the next year. Hence, in the absence of a recession, the corporate default rate will trend lower during the next 12 months. But given the already low starting point for corporate bond spread, there's likely to be limited spread tightening. So therefore, from the perspectives of portfolio diversification, and certainly from the point of view of adding protection to your portfolio, exposure to US Treasuries still makes sense, especially in cases where the downside to the economy is worse than what people think. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.